Hi, Donald Williams, CEO of Williams Accounting Consulting. Just hopped in because there's a lot of business advice and tax advice out there, and I want to give you my opinion, what's good and what's not. Let's get into it.
Here's a tax hack that poor people don't know about. Start a side hustle. The moment that you start a side hustle, you now become a business owner. And with being a business owner, you can now write off so many other things that you can't as a W-2 employee. As long as you start a side hustle that makes any kind of money, you can now write off anything related to that side hustle. You can start writing off yourself.
Okay, that's kind of what a gray area is. You cannot start a side hustle and just feel that you can attach your personal expenses to your business expenses. And that's called piercing the corporate veil. Some of it is where you're opening yourself up to exposure to where as though if your business is sued, then that opens up exposure to your personal assets to be taken and liable to cover any damages with the lawsuit. Okay? So be careful on that.
Cell phone charges, you can start writing off your computer, your internet. The things that you need to run this side hustle effectively are now all write-offs.
So, me, on the other hand, I wouldn't do that. What I would do is I would get my own company cell phone and pay it out of the business account. Most people try to reduce their overhead and their monthly expenses and trying to shift it to get a deduction, but you're piercing the corporate veil. Keep that shield of protection.
Information that you learned that feels illegal to know.
That if you start an S corporation and you own 100% of your S corporation, that you can buy everything that you own under that S corporation, and then you don't pay taxes on anything that you purchase because it's considered a corporate expense. And you can take one corporate vacation a year, and depending on how much money your corporation makes, that price actually fluctuates up, and you can actually hire your children to work for you for $12,000 a year tax-free. So then you're actually showing an expense, but you're gifting it back to your own family household. And then you pay yourself a salary, which means you pay less self-employment taxes. And then basically at the end of every month, you're left with $0 to pay real taxes on. It feels really shitty to do it, but it's kind of how you avoid paying taxes. So
okay, evading taxes and creating a business to purchase things. One, the business has to have some type of revenue unless you're going to personally guarantor. And the purpose of getting an S corporation is to separate it from your personal. A lot of things is if you beat down your bottom line and you get an S corporation like, oh, okay, I want to write everything off. I want to make sure I don't pay any taxes. But how are you going to be able to purchase the house that she's talking? You have to generate the revenue, and in order for you to acquire properties and assets, they ask you for your last 2 to 3 years, at minimum 2 years, tax returns. And if you have no profit there, how would you buy it? Yes, it is true that doing an S corporation, you're not double taxed, and you can potentially pay less on Social Security, but within reason, your salary has to be within reason, especially for your profession. So I know people always tell you the benefits of doing things and how you can get over, and it all of a sudden magically stops you from paying taxes. Gotta realize you're going to end up paying taxes ultimately. But the S corporation and trying to buy everything through an S corporation with no profits at the bottom line, gonna end up with you getting denied. Take that.
Man, I cannot believe we're both selling our companies for $3.6 million.
Dude, I know it's not.
But I'm not looking forward to that tax bill.
I wouldn't be looking forward to that tax bill either. No way. Okay, but I'm interested to see.
What? Why you give me that look? I'm selling my company and getting all the money tax-free. Dude, that's a joke.
We got to tune in to see this. Okay, he's about to give some advice of how you can sell your business and not pay no money tax-free. Tune in.
Even with the lifetime capital gains exemption, we're still going to owe $675,000. Well, I actually don't own the company. My trust does. Me, my wife, and 2 kids are all beneficiaries of the trust as well. Because of that, all 4 of us can use our lifetime capital gains exemption towards the sale of the business, meaning that you don't owe any. Another trick of the rich, I guess, and you can click the phone.
Booyah! Well, you know who's going to be looking for a trust. Yes, great, exciting news. I agree with this one. I approve this message.
5 ways that you can legally avoid taxes in the United States. Number 1, a health savings account. The money you put in is not taxed. The money you take out is not taxed as long as it's for medical expenses, and the money can be grown and invested within this account tax-free. Number 2, retirement accounts. This is your 401k, 403b, 457, Roth IRA. Max those out. This is money that the government is handing to you on a silver platter. Take advantage of it. Number 3.
Now, when that, even though it's pre-tax, so it's withheld, you're not taxed currently. But when you do get ready to take it out during retirement age, you can be still subject to taxation. So that's something you want to pay attention to. He's trying to give you 5 ways to avoid paying taxes, but it's currently at this moment now, but retirement money is still subject to taxation. All depends on what type of retirement account you have.
Number 3, long-term capital gains. This is money within your taxable brokerage account, like your Robinhood account, TD Ameritrade, whatever you have. Anything held longer than a year within this account is taxed at a significantly lower rate than if you were to sell it within a year. For most people, long-term capital gains is 15%, but if you were to sell anything in under a year, it can be taxed as high as 37%, depending on your income.
Yes, and when depending on your income, if you're average under $100,000, you're not going to be taxed at 29%. So that if you share, and I tell people all the time, it all depends on what your situation is and what you need and how much of the money that you need to make it. Because most people feel that, hey, I need to this money's here and I need to leave it there for 10, 20 years. But you're here today struggling. So some of it all depends on the sacrifices you want to make. But long-term and capital gains, there are other ways that you can take that money and reduce paying even more capital gains.
Income. Number 4, starting a business. If you run a business out of your home, things like internet, electricity, pretty much any utility can be at least partially written off your taxable income. Make sure if you're going to do this, talk to a tax professional to find out what qualifies and what doesn't. And finally, no, it's not life insurance. It's real estate. The amount of tax benefits that come along with real estate are too many to list here, but Google it. It's a lot. And follow basic financial literacy for more financial tips like this.
One of the biggest things I'll give you with real estate that comes along with it is depreciation. Depreciation is also that helps you strengthen your bottom line. When you can, it also decreases, but when you're purchasing assets or trying to get financing and you have depreciation with real estate, it then in turn helps strengthen your financials for you to acquire the real estate. So depreciation in real estate, yes, that's the way to go. That's my opinion right there. Stay tuned for more.